Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending Jan 31, 2020, the end of January, first month of 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is markets need a flu shot. Well, interesting week. I mean, all of the markets basically globally were down. The Dow was down about 2.53%. S&P was down 2.1, NASDAQ down 1.76, the Russell's down a whopping 2.9%. And for the month of January, just about every market in the US right now, year to date, is in the red, with the exception of NASDAQ. NASDAQ is up for the year, this very brief period so far, 2.95%. The worst performer for the year is the Russell. It's down over 5.75% for the year already. The Dow is down 3.86%, and the S&P is down 3.31% for the year. So, really interesting. This past week, the S&P was relatively flat. Nasdaq actually managed to it finished, all of them basically were down for the week, of course, but I guess what I'm saying is the markets have just started off the year relatively poor, in a risk-off type of environment with the coronavirus coming into bear here. Now, there's stats that show if January finishes in the green, then typically the market's finished, over 10% for the year. Now, if it finishes in the red, it just basically means the markets can expect more chop for the year, but that's something that our members have already been expecting. Volatility for the week, actually from prior week, it finished up 21.62%. So the VIX moved from a close of the prior Friday's close at 15.49 to this Friday's close at 18.84. Now, we did see a spike in volatility a little bit higher than that, but we closed out the week at 18.84. And the best performing sector this week was clearly a risk off sector, just barely above water, but it's 2 weeks in a row of finishing strong, is XLU, the utility sector. It finished up 17 basis points. And the worst performer for the week was energy. It was down about 2.64%. Now, the current trailing PE ratio for the S&P is sitting at about 25.77. The forward PE ratio for the next 12 months estimates are at 18.75. So the forward PE over the forward 12 months is about 27% lower than the trailing PE. And the annual dividend yield right now for the S&P is sitting at 1.82, and the 10-year interest rates are at a really low 1.52%. So the annual dividend yield in the S&P is 30 basis points higher than the corresponding 10-year interest rate. So we're still in this mode where markets and big money can do better in equity markets versus in U.S. Debt and bonds and bills and notes and things like that. So it's still going to continue to funnel money into the equities, although there are different equities where the money is going to. Like I said, this market action this week ended on a down note with a potential contagion of the coronavirus. I mean, already we're seeing it spread around, and the World Health Organization came out this past week and officially declared it a global emergency. So this risk-off environment, we got to kind of look at just how the Chinese are basically going to handle this. They've been to make things, I guess it's better rather than worse. They've been closed for their Lunar New Year holiday for an entire week. So that's probably, with all the travel that's been going on, it's going to hurt their GDP more so because this tends to be a very big spending period for the Chinese, much like the Christmas holidays are for Western governments. But the Chinese, with the lunar holiday, China has slapped a huge travel ban across China and really locked down some of their markets. But how President Xi reacts to this and how he shuts down the potential contagion of the coronavirus is going to really drive a lot of the risk on, risk off over the next 30 days. Keep in mind, China's economy now is the second largest globally. So any missteps that Xi does with China are going to be felt everywhere. We're seeing travel and casino stocks being hit hard, like when an MGM over in China, those stocks are down a pretty good bit. Obviously, some of the commodities, oil is down over 16% in January alone. Copper's down over 10% in January alone because China's the biggest buyer of copper. So those two are taking a beating this first month of the year. Analysts are already starting to revise downward the GDP growth for China from 6% to 5.6%. So it's about a 40 basis point drop. And they've reduced the global growth by about 20 basis points. Okay. And in here in the US, three major US airlines have banned all travel to China, not just for the weekend, but for the next 2 or 3 months. We've got Delta, United, and American. I think United and American are banning travel for the next 2 months, Delta all the way out to May. But I think if they get a handle on this, you'll see them reverse course on that. But right now, the travel warnings are there. No one's going there. So that's going to just slow down spending, global growth, a whole host of things that are going to just kind of contagion. And the markets are trying to put this into their valuation models to determine just how much of a bite it's going to take and where valuations need to be. What's a fair value before buyers start to step in and pick it up? And then, we're seeing that the CDC, the U.S. brought 195 Americans. They evacuated them from Wuhan, China, back to the U.S. And as a preventive measure, they put them in a 2-week quarantine. That's the first time there's been a mandatory quarantine like that in over 4 or 50 years. So, these are some things that have really kicked off the month of January. And you could probably label this a black swan, although I don't think the markets have reacted as negatively to it just because there's so much money sloshing around in the economy. Because a black swan, by definition, is an unknown unknown. So it was unknown 4 weeks ago about the coronavirus. And then when it popped up, and what it's doing now, the only unknown is just when are they going to be able to get this thing contained. So what we want to watch for, and what I'm telling our members, watch for the degree of reported cases. They're clearly going to go up because there's a lot of people that probably have it that don't know they have it. But watch for the reports of the growing cases slowing down and then the death rate slowing down. Once that gets a handle on that, then you're going to see the markets react, I believe, very favorably. But one of the other things that we've seen in this risk-off environment, global debt, the total debt below zero rose over $2 trillion in the month of January alone. Okay, it was up to 17 trillion, brought it back down to, around 11 trillion. So a lot of global debt over the past 2019 year has moved off of that 17 trillion underwater, or at least interest rates below zero. But just in January alone, it's moved back up to over 13 trillion US dollars. So about 2 trillion in debt went back below zero, which, clearly there's a lot of stimulus out there and even more, and debt, this going into debt is driving yields lower and lower. And we're also seeing this play out in the U.S. markets as well, because the U.S. 10-year rate has moved from 1.91% down to 1.52%. That's a 30 basis point drop, as I said earlier. Huge. That's a 20% percentage-wise drop in interest rates from the beginning of this year in January. And the bond market, a lot of analysts are trying to say, well, what does the bond market know that the equity markets don't? Because bonds have been moving down, up, and equity or interest rates have been moving down before the coronavirus was really even known out there and at least published. So the bond market, keep in mind, it serves as a proxy for future expectations of the economy, and in this particular case, it's not given a high degree of confidence. Now, granted, we probably moved down 20, 30 basis points just on more of a risk off kind of environment. But it's still extremely low, given that we're only, uh, what are we, 3.3% down, 3.31% from the all-time highs in the month of January for the S&P. So, I mean, it's really amazing, and with all the issues that we're currently dealing with in the markets, let's not forget that we're in the thick of Q4 earnings season, and so far companies are holding up fairly nicely. Well, of course, the earnings expectation bar, I was trying to get it out, is very low, but it's much easier to pull in a beat when you've got these very low expectations. But keep in mind that on a go forward basis, the 4 earnings periods in 2020 are expected to see earnings growth grow on average 9%. But even if you cut that in half to say 4.5%, we still can see positive price action. I've still got a positive price action on my chart here that I'm looking at. So if you look at this chart, it's an Ichimoku. It's a weekly chart, okay? And I've defined the fib nodes based on the lows and the prior pivot low and high off of the December quarter, and then the summer of December quarter of fourth quarter of 2018, and then the summer of 2018. And you can see I've got a high on here of 35.78. And I can see the markets moving up there. But as I said, and I've told our members, and you guys too here on this weekly update this weekend that watch me, it's not going to be a straight line up. And this is a weekly chart. And you can see here on this weekly chart, there's a lot of energy that moved these markets up from September through where we are right now, a ton of energy. And I expect that energy is not going to be dissipated that quickly on this weekly chart. And if I take it down, because the markets are fractal, so let's zoom in a little bit to a daily chart, and you can get a better idea of this. Really, on a daily chart, the markets are still bullish. I mean, on the Ichimoku, we moved bullish in early September 2019. Okay, and then the markets have just been on a tear really since then. There have been a couple of backdrops, and then you can see right here, and then it was confirmed bullish up again, and it never looked back on October 16th. Okay, so from October 16th on, we've been confirmed bullish up, and you can see the MACD. There's no divergences here on this MACD, and of course, if we look at the volume, you can see this purple line is a 5 EMA, the blue line is a 20 EMA of volume. So you can see on this daily chart, I like to see price action confirmed by volume clearly, right? And by looking at it this way, you can see that really this low here was in the holiday season, Christmas and New Year's of 2019. But really, since we had this kind of a sideways action and then an explosion higher right here, volume picked up big time. Okay, the 5 EMA moved above the 20 EMA. So that's basically 1 month over I'm sorry, 1 week over 1 month in volume. And then obviously with this big pullback here, we've had these spikes, but volume has supported the move that we've had in January. So again, that tells me that we've got a lot of buyers that are sitting there, and probably even more so sitting on the sidelines just waiting to see if this thing comes back a little bit more, they're going to pick it up. Now you can see, let me go back to a weekly here for just 1 second. I'm going to show you these colored bars on the screen. So you can see here in this colored bar, it's system generated, but you can do it with a combination of Gann and Fibonacci. Gann does a lot of time series as well as key price levels and pivot points, and Fibonacci obviously just does extensions off highs and lows at key percentage point rates. But this calculated very nicely over a weekly. That's why this bar is much larger. A huge resistance point here, sitting a little bit over 30.70 roughly, and we spent months trying to get up above this right in this area here, almost 4 months just trying to get above it in 2019. And you can see that smaller one that was generated on a daily chart where it provided resistance also. And then we sat here for a long period of time too before we finally busted a move above it too. You can barely see this move, this small bar here, which was generated on a 240-minute chart, which I kind of view as the X-ray version of a daily chart. I'll show you that in a minute. So these bars have significance coupled with the fib extension nodes. They come into play, where we can expect, not guarantee, but just expect some resistance, because it's just human nature. After you get a certain level of gain or loss, people are going to get in and out of stock. So if we come back to a daily here, again, you can see the purpose of these colored bars. So now looking at this here, I will say also going back, we've got to go back a long time. I mean, let me just see how many times, how far back do we have to go? Okay, check this out, guys. We've had, right now, we've had 2 days in a row of 2 red candles, meaning down. Okay. The last time we had 3 down candles in a row. 3 days where the S&P moved down was early December. And before that, and you guys can just go back in time and look at them and see, was right over here, right? And that was back in August timeframe when we had that 8% pullback right here. So in this one right here, we did not have an 8% pullback. It was just a brief dip right here. Okay, this was a pullback here. I define pullbacks as between 5 and 10%. Greater than 10% correction, a dip is 0 to 5%. Okay, because that's all it is, just a little dip. All right, so now we've had one bar here. Where are we going to go from here? Well, the reason why we had such a big sell-off, or one of the reasons, clearly the WHO came out and declared it an emergency, but the markets moved up on that day, right? I mean, it was kind of a false flag kind of event. The markets moved up when they came out and officially declared it an emergency. So let's dig in and kind of put an X-ray view on the daily chart by going to a 240, staying with the Ichimoku. Okay, so you can see here when the WHO did that. I mean, the markets reversed from this down move here and closed up here. We took out the prior pivot point high right here. So that kind of changed the dynamic of the market on Thursday. And you could see the overhead here was green, right? This would be considered your first level of resistance. But at that point in time, we had already changed to red over here. All right. So going from a green color to a red color in Ichimoku means over time, the bears are starting to take hold and went out, even though we moved up solid here. And then look at what happened on Friday. We never looked back. We just had a complete meltdown. And then here we go. Now here is our R1 level right here, which is kind of a resistance zone, which fits in this overall zone right here that I was watching. Now I drew this bar on here because we had a Elliott wave 3, 4, and 5 pattern, and then there's sub waves within this 3, 4, 5, but overall a 3, 4, 5 pattern. And this typically puts this, it does the calculation, as I said, using a combination of Gann and Fibonacci to give you an Elliott wave 5. And typical of an Elliott wave 5 is an end of trend. And assuming we get a little bit of a chop here, you're going to see the MACD kind of do one of these kind of things. And then if it moves up any, it gives us a little bit of a bullish divergence. Okay, this would be a poor man's bud because we've had multiple crosses in between the major pivot crosses in the MACD. Should it cross here? Now, I don't know what's going to happen, but should it cross, that would suggest there's going to be a little bit of upside here. And typically after an Elliott wave 5, you get an A leg, a B leg, and a C leg, kind of like this. And where the pivots are formed is going to define, et tu, Brute, where are we going from here? Okay. And I believe the coronavirus, at least right now for the markets, they're treating it more like a temporary thing. So I think there's buyers just itching to step in, and they're probably hoping that the markets will pull back even more, and then they'll come in. Keep in mind the SARS virus, the markets pulled back about 10%. We had a MERS virus too, which is of the coronavirus strain. It's all of the same type of strain. It's just a new strain. And, we get them every 5 or 10 years, I guess. They all seem to be emanating from China. That's probably because how they handle their meats and their wild animals and animals at these animal markets, which if you were to walk through there, don't do it if you do it on an empty stomach, you will not want to eat. If you do it on a full stomach, you'll get sick. It's wild. But what I'm saying here in these markets, this is kind of what we're looking at right now. So now the question is, on this 240-minute chart, we came right down to this area, and it was kind of split the difference, roughly around 32.20, and we can expect an up move. So now the key that I'm going to watch is there going to be enough energy to move us forward, or is it going to be like a false flag? It's going to be a bull trap kind of thing where we move up and then we roll back over again, much like this was a bull trap here, and just kind of head fake the markets. And it really wasn't. I mean, the definition of a bull trap is not to take out a prior pivot high, right? On this chart, I would have expected a little bit of a stop because we had this kind of thing going on just like that, right? So we're making a series of higher highs, higher lows. But the cart was upset on Friday. I think there was a little bit of panic selling as we're going into the weekend. And like I was starting to say, one of the primary reasons is because China's been closed for a week. So everybody's concerned when China opens up Sunday evening, there's going to be a lot of selling to catch up with the rest of the market. And just what is China going to do? Right. And a lot of these people that may be holding stuff, how are they going to react to it? Okay. And plus, it's a weekend. So, if some really negative news comes out, we can just, roll right back over again. So that's a little bit about why I think the selling was a little bit overdone, but they're trying to get ahead of some of this sell-off here. We're like I said, the S&P is only down about 3.31% from all-time highs. That's not much. The Dow is down 3.8%, and the Russell is down the most. It's down over 5.75%. NASDAQ is actually up. So you can see where we're sitting here on these markets. We got a red cloud above us. That does suggest that the market's going to have a hard time getting up above it. Okay. It is a more of a bearish kind of go forward environment than a bullish go forward environment, but this can reverse very quickly on this chart, just like we got this pattern here and this pattern here. When they all clear, you're going to see buyers come in pretty quickly. Okay. So that's a little bit about that. Now let me just switch the view here real quick. Let's come over here. Let's see here, where are we going? Let's go over here like this. So let's go over to screen number 5. So you can see here in this that we've got, this is NASDAQ. So I told you NASDAQ's still in the green. You can see where we closed 2019. So we're still in the green. But let's look at the Russell, guys. The Russell has just been killed. We actually, this is a day chart, we actually made a 2020 low this Friday. We closed slightly off the low. We're in a support zone right now. We're well below the 50 EMA. You can see the 50 EMA was kind of providing a little bit of support here. And then on Friday, just gave it all up. Next stop down, there's a value area sitting here right around 1592, and just below that's the 200 EMA. Okay. Now, we did have a beautiful signal to go short the Russell. We had a bearish divergence, and for our members, it was not a poor man's bed. It was a good one. We had 3 crosses, or just like that, right? So it was a 3x cross, and we had a high and a higher high. Right on that trigger, right there on a daily chart, on that candle right there was the trigger to go short the Russell. Okay. And we're down in this area down here. So I think the Russell, we're in also an otherwise price level support zone right here, and then right below here. So if we break that, we're going to test this pretty quickly, and the rut can drag everybody else down. Okay, the rut has been trailing the S&P and NASDAQ and the Dow since 2009. Okay, so low interest rates and interest rates going lower it tends to hurt the Russell because there's a lot of banking stocks inside the Russell index. So that's another reason why the Russell tends to fill it in the chops when we see really low interest rates like this. Okay. Now, if we look at the Dow is below zero for January, and you can see the Dow also came in and tapped the low for 2020 because it made a low in January 8th, and then it came down and hit it almost to the T and then bounced just slightly above it here. The Dow is also below the 50 EMA, okay? And we're below the 2019 close. There's a lot of support in the Dow, but that's all the way down to 27,000, okay? And believe me, that is a little over 1,000 points, but we can get it in less than a day and a half because the Dow was down over 600 points on Friday. So it won't take long to get down here at this rate, okay? Will not take long. And then, of course, if we look at the E-minis back again here, you can see same chart where the 50 EMA did provide support for the S&P. You can see the red line right here is the 50 EMA. You can see the low that was made on January 8th, intraday low. So that's the 2020 low, the 2019 close. So we're slightly, just barely, by about 9 points in the red for the S&P. So that was all practical purposes flat. Okay. Notice on the Russell, I'm sorry, on the Dow, the S&P, and NASDAQ, there were no divergences. Only on the Russell did we get the divergence in price. And of course, if we look at volatility, you're going to see here the VIX did close. We're in the yellow right now. We're in the mid of the yellow zone. All right. And for those of you that follow me know that we've got um, it's the yellow zone is basically running from a little over 15 to about 22. So we change some of our option strategies. We start prepping up, looking for more of the credit spread kind of environment when we've got rich premiums sitting in front of us. Okay. So you can see how we're just chopping around at this level right here. Now, if I just kind of step it out a little bit, you can see that we've still got some highs that we may or may not be able to take out. Okay. I mean, if you look at it in this zone right here, we took out these guys right here, but we're kind of sitting right in this level here. And then if we perk our way up here, this was in August when we hit about an 8% down move. The Russell was up around 25. I'm sorry, the VIX was up around 25 VIX, but it didn't stay up there more than a day, and then it came down. And as it comes down, it's a lot of chop as it comes down, but that's just natural. Okay, so we can have some of these spikes, and if we get over again, we're only down about 3.31%. So if we get another 5 to 7% down move, we're going to be back up in this area here challenging this. Now, keep in mind that there were not very many shorts in the volatility market. 30% of the short interest was closed down in December 2019. So short interest dropped by 30%. So what that means is any pop and vol is not going to be as strong as it would have been if we had more shorts in there, because the short covering rally probably would have goosed the VIX up another 4 or 5 points. So that, in essence, in a Machiavellian sort of way, helped help kind of tamp down any bigger volatility spikes. Okay. So what we would expect, what I would expect, is if we kind of get up in this level here, you're going to see some shorts start to come back into the market again. Okay, in the VIX futures. So I would not be surprised to see that. Let's look at interest rates here. First, let's look at bonds. Bonds were up. Look at this regression channel here that we've broken. And in the bond market, we've taken out that pivot high, that pivot high, that pivot high, and now we're working on this pivot high right here. It may be slightly up like that, right? So we've had this huge move up right here, and this is all of January. Since we've entered January, there's the opening of January, that line right there. Since January, bonds have been on a tear straight up, because I think January, the the risk was coming out of the market with some money, just booking some profits and just saying, okay, let me sit on the sidelines. But once you get up there, I'm going to put my Pirates hat on, give myself a little bit of an eye patch, and give myself a smile, because I'm going to be more looking at shorting bonds than going long bonds up in this area here. If we have a final capitulation up here, I'm going to be looking for that, because I think bonds are getting a little bit ahead of themselves to the upside. Okay. And by the same token, I think interest rates are just getting a little bit lower than they really should be, just given where we are in the overall markets. If you look at the 10-year interest rates, again, just the opposite. There's the upsloping channel, the regression line, and now we're back down close to the 2019 lows in rates. All right. We closed the interest rates, as I said, at 152, and 151 was a previous low that was made in October of 2019, and it was only surpassed by the lows that were made in the beginning of September. So if we take these out, it's going to have a different effect on equity markets than people think, because now the equities are going to sell off a little bit more, because they're going to just make the assumption that with the interest rate so low, it's an expectation, and already the expectations moved over 50% that the Feds are going to cut the rates again. And that's just going to drive the interest rates, and the bond market is going to kind of dictate the terms to the Feds. Okay. If we look at the currency market, all right, if we look at the dollar, you can see the dollar is still cross between this upsloping regression channel here for all of 2019. And then towards the end of 2019, as we started getting that strong bullish move in the markets, you can see the dollar has slowly been making a series of lower highs and lower lows. Okay. And we're now stuck in both channels, both the upsloping and the downsloping channels. So that tells me we're going to be into some chop for a while here. Although I do believe if earnings come in as forecast for 2020 and we do move up to 35, 3600 in the S&P, you're going to see the dollar come down much lower, and it's going to start to resume this trend that has been picking up really since October of 2019. Okay. The euro, if we take a look at the euro, it moves opposite the dollar in general. You can see here, though, we're still in this down trend line here, and the euro is about 58% of the value of the dollar index. So generally where the euro goes, the dollar goes in the opposite direction. So you can see here, if we move up and take out this pivot high here, then I'll be a believer in the euro. Until that happens, then I'm not. I don't see any signal here on my indicators that would indicate the euro is about ready to go ballistic. Let's look at the pound. That's been really interesting. Okay. The pound is starting to break back up again. You can see this tightness of the correlation of the down and then the up, right? It's just been very tight. And that currencies tend to do that. Currencies tend to trend. And now that this past Friday was the official vote of Brexit, they are no longer part of the EU. Now it's just a matter of how are they going to work with the EU on a number of different things, from trade to travel to all these things. The EU thinking they're not going to be able to get it done by the end of the year. Boris Johnson saying we're going to get it done by the end of the year. So it'll be real interesting to see. But overall, I'll be basically bullish the pound. Okay. When it started moving up here, as you guys remember, I was bullish the pound. And I think it's going to move up higher. I think eventually the pound's going to get it back up over 1.4 to 1. Okay. So we're going to see that. And I don't think the Great Britain's going to be as affected by some of the fear mongers out there saying that the whole economy is just going to be decimated. I just think that's more fear than it needs to be. Okay. Now, if we come down here and we look at metals, let's look at gold for a minute. Gold, even with the hard down move, did move up too much, but we're getting this kind of cup and handle with a little bit of a handle pattern right here, moving back up to the 2019 high. As I said, my target for gold that would probably end this Elliott Wave 5 up is around a 1637, 1640 area, and then we're going to get into some sideways, a little bit longer sideways chop. But I do believe that I don't see much more upside than this should the market start to grow, move higher, and interest rates kind of come back off of their lows. We'll see a counter move in the gold market. Okay. Remember, we got long gold right over here back in June of 2019. We had a beautiful break. And now we chose to go long silver because silver outperformed gold during this move higher. And then this was just a profit taking mode. We took out the prior pivot here, right? If I were to put this on here like that, we just took out the prior pivot high just like that. And now we're sitting right at that level right there. Okay. So I do like gold, but let's look at copper. I call that out. I mean, copper is ugly, ugly, ugly. This is a daily chart. It looks like a biotech that failed the FDA approval process, but it's a commodity. I mean, copper just fell off the table when the coronavirus really just kind of came known, and then you started seeing reported deaths and so forth. Copper has just been a one-way trip straight down. Okay, and we're now back to the lows that we haven't seen since August of 2019. In copper. So it's been a great trade for people that are on top of it. Remember, copper goes where China goes. So if China looks like they're going to get ugly, you want to be short copper, or vice versa. So by the same token, when this coronavirus is solved, or it's not going to be solved, you're going to see a slowdown in the contagion, then that's going to be a risk on kind of market. Copper would be something you want to rush to. Or if you can't trade the futures market or the commodity market using futures, use Freeport-McMoRan. You can see Freeport-McMoRan. I was telling our members way back down in here when it was around 9. This is a great bullish trade right here, right around October timeframe, early October. And it was a 40% move higher. That's where you wanted to be because Freeport-McMoRan tends to follow copper. You can see it coming down. It's starting to find a little bit of a settle in here. It's not as ugly as the copper markets. If you look at copper, right, let's come back to copper here for a second. It's coming down to equal its lows that were made back in August, 1st of September 2019, right? But if we look at Freeport McMoran, the 1st of September 2019 was right around this area down here. So it's only made about 50% of the move that copper made. All right. So Freeport fell 50% less in a duration move than copper. So that tells me copper is even more overdone, which if you can get into the copper commodity market, that would be an interesting play to do. Not yet, though, because I think there's still possibly some reflexive flush outs in the market. But outside of that, should that not happen, copper is a good place to be. Okay. Now let's look at the other side of the coin. Look at palladium. Palladium has been on a rocket ship higher. Okay. I mean, look at this move. It was 24.27. It's a commodity, folks. And the best thing for a commodity to reverse a high price is a high price. Okay. And we've had this huge fall here, over 147, 150 points, 200 points in just a few days. That's palladium, because there's no option. There's not an option market for palladium, which I wish there was, but there's not. So the big money that gets in, or even speculators, you can't hedge your trade with a contra option play. So I'm watching this move here. Ideally, I'd love to see it make it all the way back up here. I'm not sure if it can or not, but if it can, I'm going to be shorting this sucker, because I just think it's way, way overdone. Okay. I just think or palladium is going to pull back. It's hard to play as just a speculator, because the movement is so wide and it's such a big contract. 1 point is $100. Okay. And it moves not in 3 and 4 point sound bites. It moves in 30 and 40 point sound bites. So you're looking at 3 and 4 grand. So you need $250,000 to $500,000 in your net lick portfolio to be able to adequately trade this and manage off risk. Okay. Because remember, you cannot add options here or play the option market in this game. You just can't do it. So that's the metals market. And of course, if we come into energy, oil, from the peak up here, the intraday peak, it's down more than 20%. But from the closing prices, it's about 16% down. And now we're down in this area here where I'm now interested in looking at possible longs, or maybe selling some shorts well out of the money, doing some credit spreads in this thing. Because I just think, now remember, travel has been penalized. Airlines have come out and said, we're not flying there for months. The minute they come out and say, well, okay, we're going to open travel back up. I mean, they've already banned a cruise ship. They quarantined an entire cruise ship that had Chinese on there, an entire one. So you're sitting in the harbor going nowhere. So travel, global logistics and travel is just, they're not going into the ports. It's just going to really decimate the Chinese economy until President Xi comes in and does a ton of stimulus, which is going to be another risk, because they've got just such a bad financial imbalance in their economy. But he's going to pull out all stops. And I think other markets, like other Asian markets from Australia, Vietnam, India, and others, are probably going to add stimulus too, to kind of add more water to the toilet, I guess. So that's kind of what we're looking at here. But I do believe doing some bull put spreads here, or some any kind of that or a deep in the money bull call spread here kind of thing, where you're limiting your risk. I think you've got a fairly good chance here on this one. This thing I think I've been talking for the entire year of 2019, the midpoint around this area right here, around the 55, 56 level. Oil seems to be going up and down around these levels, from the high to the low. If we were to put it on a weekly chart, just kind of give you an idea of this movement here, right? I mean, if you look at this, you can just see here, and let me just highlight what I'm talking about here. It moves from these extremes, right? And if you look at these extremes right here, really since the beginning of 2019 right here, we come up, we go down, we come up, down, up, down, up, down. That's all we've been doing. If we break down right here, then we've got solid support down here for sure. I will be picking up some bull put spreads in this case right here, or bull call spreads, or just picking up some options if we get lucky enough to get a low price like that. Otherwise, you can put one on here and set a stop fairly tight, right, in that market. And then having it move somewhere in the middle there and then just take profits off. I don't think oil is going to get back up here. Already, OPEC is already bitching and moaning that they're going to do something about output here just because they're taking it in the shorts as well. So that's what I'm seeing in the oil markets. Nat gas, well, look at nat gas, guys. Here's another one. Now, I attempted it before and we got stopped out for a small loss, but nat gas just continues to move lower. This is a weekly chart. Let's put it on a daily just so that you can see this thing. Um, Here we go. Look at this. I mean, talk about lower highs and lower lows in a tight channel. All right, this is a regression channel. It's 0.96. The tighter the channel, the tighter the spread between the highs and the lows, which means if you're short, you're loving it. And you're not going to get washed out by a contra move. So we're down in this level down here. And I don't see any divergence in this. There's so much shorting in the nat gas market. If I put it back out on a weekly basis, just to kind of show you, and let's zoom out just a little bit. All right. That level there, 161, was made back in 2016. And that's kind of where I think we're heading right now. And if we can get down at this level down here, then I will be interested in trying another bull put spread. Because if you look at it, when was the last time we were down below that level? Right? I mean, look at this, guys. You've got to go back. I go back. I don't have the subscription on it, but going all the way back to 2000, the year 2000. So the lowest low that we've had for 2 decades was made in 2016. All right. That just gives you an idea of where this low is. For the past 20 years, the lowest low that we've had is right there. And we're near that right now with this abundance of nat gas. All right. And with obviously nat gas does not seem to be that correlated with oil. So generally when you have a day where oil is down, nat gas doesn't necessarily have to go down. But I'm already getting word that they're going to start cutting nat gas production because they're just burning it off at the wellheads right now. So I do believe that, if you look at this, I think it's just getting down to a point where it's just, again, very enticing to look at um, a bull put spread kind of thing. Now, we tried one way up here because I thought this level would hold, but it surely didn't. So I'm just going to wait and see, right? We've already had the cross in the 50 and the 200 EMA. It's been riding right on top of it, and then it finally crossed back down again. So we'll just kind of see how that thing plays itself out. All right, everybody, that's kind of where we're sitting right now in the markets, at least the major markets. Members, I will see you this Sunday night at Super Bowl weekend, so we'll keep our session this evening or Sunday evening brief. If you're not a member, I highly encourage you to come in and check us out. We're doing really well. I think 2020 is going to be even better year for us. There's going to be some tricks coming up in 2020 with the markets, with interest rates, debt, and equities. You got to be on top of it, guys. Have a great weekend. For those of you football fans out there, enjoy the game. I know I will. Otherwise, have a great weekend, folks. Ciao.